to our Sunday webinar. Today is the first day of a new time zone. We all went from BST to GMT time, so hopefully everybody's all back on kilter and with the right times and have the Sunday afternoon free. Now this will be the permanent new time for our Sunday webinars throughout the winter time, and then we'll switch again when we go back to springtime. So mark it on your calendar. Every Sunday at this time we'll be giving you a class, as well as our Wednesday evening classes and our live events throughout the week. Now, today's class is on support and resistance, which is about one of the most important concepts that you can master. But before we can get on to that, ETX is a regulated provider, and therefore I'm required to give you a risk warning. So let me read it while you read it also. While you read it, I'll read it out loud. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds you cannot afford to lose, and seek advice if you do not understand the risks. All information in this webinar is for educational purposes only. Remember, ETX is a trading platform only. We're not a trading advisory service. So we offer you a facility in which to make trades. So neither one of us are licensed to be a financial or investment advisor. So therefore, we don't recommend any securities or instruments of any kind. But we do give you exceptional education so you can make the smart decisions. Now, for those of you that are not that familiar with ETX, we're a fast-growing financial services company, and we are based in London, and we are authorized and regulated by the FCA, the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. Now, when you trade with us, if you're a beginner, you might want to start on the ETX binary options platform, as there your risk is minimum. It's only the dollar amount you type into the screen, and your profit is predetermined. There's no leverage or margin when you're trading with binary options, and you're simply predicting whether an asset will go up or down. It's a great way for novices or beginning traders to start getting a handle on the financial markets. But when you want to move over to something more advanced and you have a little bit of knowledge, you can trade either on our ETX Pro platform, and that platform is our online internet-based program. You just simply log in and you can start trading. We offer you advanced charts. We offer you every type of support and materials you can want, all types of order entry, stop losses, take profit points. It's and fully customizable charts right there on our platform. And those of you that want to really trade with the high-end professionals or want to learn to be more advanced, you can download our ETX MT4 platform, and with that you can add on all types of expert advisors from around the globe. You can also have our most advanced charts, and you can use our MT4 platform to automate some of your trading by building the automation yourself. It is very easy with the MT4 platform. But you have to learn to master the MT4 platform, and we do have classes that will help you with that. Now tonight's class is called Support and Resistance. There are many ways to get these key elements. So, the way I look at it is there are certain foundation tools, certain building blocks that every trader, no matter who you are, no matter what type of system you're using, no matter what type of analysis you're using, no matter how advanced you are or how novice you are, needs to have these building blocks before they can make any decision. This starts off by being able to read a chart properly. Even if you're not a chartist, and even if you're not going to trade from technical analysis, you need to be able to see price on a chart. Because ultimately, price action is the most important thing you can see. Then you need to be able to put a trend line on your charts properly, and then you need to build lines of support and resistance. From there, there's a fourth step, and that's by combining volume. These are not, so to speak, trading strategies. These are the building blocks that you have to have. Like an architect, when he starts designing a building, he still has to incorporate the basics. How much land does he have? What are the, if he's designing your house, where does the storage come in? Where's the water lines come in? What is the regulations and what's allowable by the city? How much property you have? He's also got to get you so that first cornerstone is laid completely correct. Otherwise, the whole house is out of kilter. So before he can build and design your home, he needs to get some basic information from you as the owner, and he also has to use the knowledge he got in school, and this is at least to build the basic house. This has nothing to do with you decorating, whether you want 2 stories, 4 stories, 5 stories, whether you got a lot of budget, a little budget, whether you want the walls yellow or pink, doesn't make a difference. No, there are certain basics, and support and resistance falls in these basics. So despite all the fancy and exotic tools that it employs, technical analysis really just studies supply and demand in the market in an attempt to determine what direction or trend will continue in the future. In other words, technical analysis attempts to understand the emotions in the marketplace by studying the market itself. Now, support and resistance is a common jargon. Now, the thing is, just like building a house, you might want to build a ranch, or you might be building in a city where you got to build, a multi-family dwelling, or you might be building a little type house, or you might be building a split level or a 3-story. So there's many different ways to get support and resistance, and we'll go over a couple of these tonight. But understanding what they are is crucially important. So support and resistance is common jargon for areas on a chart where price has a difficult time breaking through. So imagine, none of us really believe that price moves in a straight direction. When you're looking at some charts and you see Apple soaring all the way up the sky, or what did I see? Amazon went from $942 to $1,200 the other night. Okay, it didn't go straight up. It goes push and ease, push and ease, push and ease. Because traders don't buy continuously. They take breathers, they take interims. There's a point where the price has moved up far enough that a lot of earlier buyers say, okay, I'm going to take my profit and ease it down. Or the buyers just get tired out and they need an hour. They all went out to lunch together at the same time, all the buyers, and the price will ease down. But a well-constructed trend line and a well-constructed trend moves in these patterns, push and ease, peaks and valleys. Okay, and it's important to know this, but it's also important to know what levels these peaks and valleys should come at. So knowing where these levels are make it much easier to decide when to open and close trades. But how can we locate these prices to begin with? So again, let's go to a hypothetical stock, because I'm not sure what I don't follow stocks at all. But let's go to a hypothetical stock. We'll call it Berry stock. Okay. Now Berry stock was moving up nicely. It went from 10 to 20 to 30, and I'm saying, everything I'm reading about Berry stock is great, and I want to buy Berry stock. Well, it's moving straight up. Do I want to buy it at the current price, or how do I know it's going to continue moving straight up? Now, because we know the price moves in peaks and valleys, would I rather buy when it dips down to a valley and buy at that lowest point, so when it moves back up, I'll get the advantage of that whole move? So understanding support and resistance is very, very important. Now, support and resistance can have numerous applications and can be identified in a multitude of ways. Traders can use support and resistance identification for managing risk of a trade. Traders can also use support and resistance to grade market conditions and enter positions. One of the more difficult concepts within technical analysis is grasping the premise for support and resistance. There are numerous ways to identify these levels, and even after identified, there's a plethora of ways of integrating them and trading with them. So one of the best reasons to learn how to read a financial chart is so that you can apply these building blocks, these foundations, okay? And they all fall into the area called technical analysis. Because once you have a chart, anything done on that chart is considered technical analysis. Now, imagine, I'm going to try to give you an easy to understand concept, and then we'll take that and try to apply it to what support and resistance are. So if I were to take you and paint you gold and say gold is trading at $12.50 today, and I was to push you into an elevator, and gold was on floor 1250. Now, What is supporting you? What's below your feet? The floor is below your feet. It's your support. When you want to move up, you have to break the resistance. That's the ceiling above your head. So for that elevator to move up and to move that price of gold, it's got to move up through that ceiling. When you go through that ceiling, it becomes the floor under your feet or becomes your support level and helps you move up to the next price level. When you go down, it's the exact opposite. So if you're at 1250 and price is easing down, what are you doing? You're jumping up and down like a maniac, breaking through the floor below your feet, going through the ceiling of the next floor, and what happens? The ceiling becomes your resistance level because you can't get up above it, and the floor becomes your resistance level because you got to jump up and down it to get through it, and that ceiling is your support level. So they're reverse concepts, basically whether market is moving up or down. So imagine your gold. I pushed you in this elevator at floor 1250, but guess what? Gold doesn't have any hands. So gold can't push the buttons on the elevator. So gold's just got to hope it's going to stop at some floor. And when it goes down, if it's going up, it's got to hope, or when it's going to go down, it's got to hope. So we can do analysis to figure out what the most popular or what the most prevalent floor is that the elevator stops on. So if we know that this building, this 1200, it's got gold at 1250, has a roof at 1230, which say 1300, and it's a smoking roof, it's a smoking area with a restaurant. We know gold's most likely going to jump most of the floors in between and end up there. Okay. When gold goes down at 1225, okay, it's a big attorney's office, lots of people coming and going. So we know there's a good chance that gold's going to stop going down at 1225. Below that, at 1200, we have these huge conference rooms, and we know there's a big conference going on in the auditorium today. So there's a good chance that gold's going to stop at 1200 when it's easing down. So they're only odds and probabilities. Okay. But when we can establish what they are, we can use these to our advantage. So there are no firm, definitive, guaranteed price levels. Okay. Gold can push right through, or the asset can push right through any of these levels. They are warning prices to tell you that you should expect the market to do something. So imagine gold went up, you just got on gold on the elevator, gold's at 1250, and it goes up to 1300, that smoking floor, that lunchroom. Okay. Now, if gold eases back down, as it's easing back down, you are sure gold's going to go up. The rally is very strong, the trend line is very strong. Well, where would you expect that elevator to slow down and stop as it's going down? Well, 1250 is a popular floor, 1225 is a popular floor, and 1200 is a popular floor. So if the elevator goes down, it goes right through 1250 without stopping, we know most likely you'll stop at 1225. Goes right through 1225, we know the next level is be 1200. Well, at 1200 it stops and it starts to reverse. The elevator starts to go up. Well, if you were to believe that gold was going to rally and continue its rally, you would want to enter back at 1200, not at 1250, not at 1300, because as that elevator just rides back up to where it was, you would be making profit. But you wouldn't want to get in gold at 1250 when it's going to fall down to 1200 or 1225, even though it's going to turn around and go back up. You might get stopped out because these support and resistance will help you determine where to enter the market, where to exit the market, where the market's reversing, or also how to determine where to put your stop loss, your take profit points, and know how to trade the market. So, defining the concept of support and resistance is fairly simple. When discussing it in the context of stock market, it defines the level which buyers and sellers step into the market, or where the law of supply and demand come into play. Imbalances in supply and demand create support and resistance levels. For example, when an overwhelming number of buyers step into the market, an indication of support is being put into the marketplace. Conversely, a large number of sellers indicates that there is overhead resistance preventing the stock from moving higher. Now, the price levels which create support and resistance in a stock only tell half the story. We mentioned a key phrase above, overwhelmingly high. Volume can also be combined into your interpretation of support and resistance, because volume is the number of contracts or stocks being traded in a time period. If volume isn't supporting, if say when a stock is coming down and easing down, it comes down to that, gold comes down to that 1225 level, we should see the volume start to increase as the buyers step in the market to push the asset back up. If we don't see that, then they don't believe in that price level, and that's when it'll probably fall to 1200. 1200, okay, we're not guaranteed it's going to bounce off of there, but we want to see more and more buyers entering the marketplace. And this combined helps you start interpreting the market. Now, there are many ways to get support and resistance. My favorite one, and the one we're going to spend most time on tonight, is called eyeballing. Eyeballing is pretty easy. Back in the old days when I first started trading, 40 years ago, when we didn't have computerized charts, we didn't have computers at all. You know, some brokers had these big rooms that made up a computer, but most people had no computer access, and we definitely didn't have computerized charts. We would be doing hand charting. And even though today we have all of these advanced, complicated, easy informational charts, eyeballing is still basically done by hand. And this is what helps you actually outwit and outsmart the other traders in the marketplace. So let's go over, first of all, let's see what these lines are, and then let's see how we would apply eyeballing. So hold on, I've got some charts ready for us. So let me pop them up on our screen. I talk about gold. Look what I got up on the screen, gold. I like gold a lot, don't I? Okay. Now, these lines that are drawn on the chart have been there for weeks, okay, having nothing to do with today's trading, today's price. These were lines of support and resistance that were drawn way back when. Okay. Now, lines of support and resistance stay correct historically. In fact, some of the more older lines, when it's moving in a price, because the only thing that matter are the support and resistance above and below today's price. But sometimes, because an asset hasn't spent much time at this price, you have to go back far. Because what we're going to be looking for with eyeballing is prices that when the asset was trading near where it is today, that were crucially important to the marketplace. In other words, where buyers hemmed and hawed in the past. Okay, where there was lots of opens and closes or highs and lows, all similar levels that we can actually put a line through. Now, like I said, these numbers have been pulled through from a long time back. Okay, and if you notice right here, let's use this yellow line first. This yellow line was drawn on months ago, but it extends forward, and it happens to be that the price of gold is right about in that level. And this 12.75.9 is a critically important price. Even recently, okay, we can see all of these tops right here at that 12.75 level. Okay, we can see here lots of bottoms and closes at that 12.75 level. Here we can see, well, this is a higher level at the 12.78 level, and that's why it makes another level of support. And we can have as many levels of support and resistance we have. Okay. Now, what makes you better, because once we go to using pivot points or Fibonacci retracement levels, or we use the computerized algorithmic support and resistance level, those are the same things everybody else has. And what you're trying to do is define price levels and price ranges that are critically important to the market, but not everybody else might have. Look, if we go down here to this red level, which again was drawn on this chart ages ago and extended forward. Look how important this level was to the recent trading. And that was a critically important level. So what we do to do eyeballing is we look at where price is currently. Because again, that's the only thing that is important. And you'll find that when you draw these lines on your chart, they can be extended forward. So gold may eventually go up to here, say, and these lines will have no bearing. But when gold falls back down into this range, those lines can have bearing again. So we can keep these lines on the chart as long as we want. And the more times that we see congestion at that particular level, the more important those lines are. Now, there are several ways to eyeball these. My easiest way to do eyeballing, and eyeballing is a unique technique, is number one, is to go back to old, longer period charts. So if we go back to 1 day, okay, we can see that again on the 1 day chart where numbers or where prices were crucially important to levels. We also want to look at these levels in Dev's point with volume. Okay. But we can see when gold was here at the 1300 level, okay, we drew these red lines on. Again, we drew these yellow lines way back when, and they've been extended forward. Okay. And what we're doing is we're looking historically what prices were important before. Where did prices hem and haw before? So we can see this red line was another line that buyers had a difficult time dealing with, pushing above or below. This red line, we can see that. And this is going back all the way to March. Okay. We can go back farther. And extend these lines back as far as we want, or look for lines moving forward. The more, like I said, the more historic value we find bringing these lines forward, the more important they are. Now, a lot of people say that the longer the line goes, the more value it holds. I say that I won't look back more than a couple years. The reason being is a lot of times assets are at prices where they haven't been in a long time. If you try to do analysis with Bitcoin, look where it's trading. It's trading, you know, at $6,000. It's never been at $6,000. But when it retreats back down to 5,300, I think it actually did, you can then find some prices around 5,300 that were critically important last week and 2 weeks ago. But when it falls back down, if it ever does, to 1,200 or 2,000, you're going to have to go back 6 months ago to find what price in that $2,000 range was important. Now, we've taken these lines and projected them forward. Okay. And by changing our charts, we can now see these in relationship to the current price move. Now, the fact is, we haven't seen gold at this level where it's been for quite some time. So we would have to go back pretty far to find more definitive points, because when we look at this level here, and it doesn't matter how far back you go, if you can find significant levels that happened over the last month, that's great. So we see here, this is on the 23rd of October. We see here, this is the 25th. We see here, this is just the other day. These are all important levels to gold. So when we see gold recovering right here and moving back up, we're going to look, set 1275 as an important level. We already have 1278 and 1279. So we're going to be looking for some type of price action at those levels. And if we were to enter the market, okay, we might enter it when it broke this support level, this resistance level, and moved up to the next support level. Or we might build a zone out between its current price and where it is now, and say when it breaks above through there, we'll do that. But where would we set our next highest level? Okay. And the other thing is there's many ways to trade, because prices will bounce off of support and resistance levels. Okay. Because price doesn't move in a straight level. If we look at where price has been moving, first of all, this was a very developed downtrend. Thrust and ease, thrust and ease, thrust and ease. So we could almost say that we can find support and resistance levels by connecting peaks and valleys over a time span. Okay. Now, we've just moved it back to a 15-minute chart because in current trading, we want to, the only thing we're really concerned about is where price is today. Okay. But how traders reacted in the past is critically important. So again, we have a nice developed uptrend, but we're not sure if this is an uptrend or just simply a retracement of this downtrend. Will gold continue moving up, or is this just a reversal of this sort? And it might just get up to a Fibonacci level and bounce off of and come down. It might come to this 1275 level and come back down to 1267. We don't know, but we can sure make a decision that we're going to watch those two levels, and then we will make our decision after it. So if it comes up to this price level, 1275, can't break it. Okay, tries very hard, once or twice or three times, 4 times, 5 times, maybe an hour or two, can't break it. Most likely the buyers don't have any momentum. Because if we look at this, we have a rally upward, we have price approaching this support, but look at where volume is. It's telling us something about that price move. The buyers don't believe in that price move. So we might expect it to come here. So let's talk a little bit more. Let me take it back to the PowerPoint. We'll talk a little bit more about how to find these and what they are. So give me a second to get my marker out here. Now, you also have to remember that a crucial importance is that price support equals resistance. So here, there's an old NASDAQ chart, and we can see historically the price of this asset moved up to this critical level, touched a high, bounced off, and came back down. Moved back up. Now, this time it moved back through there. But then it came back down and got stopped at that level, moved back up, came back to that level again, moved back up, and came back to that level again. So this level, when price was here, was a resistance level. When price moved up to here, it became its support level. So there's a principle that, another principle of technical analysis stipulates that support can turn into resistance and vice versa. Once the price breaks below a support level, the broken support level can turn into resistance. The break of support signals that the forces of supply have overcome the forces of demand. Therefore, if the price returns to this level, there is likely to be an increase in supply and hence resistance. Now, here are some quick tips. Watch for breakouts. As we noted above or over here on the right, prices can and do cross their support and resistance lines on the way to forming new trend lines. Use the current levels as guides, but realize they will change over time. Think of changes as opportunities to mark profit. Number 2, when charting the price action of an asset, and remember, price action is the ultimate thing of importance. Okay? All the rest of it just gives you some interpretation, but price action is what you have to look at. So when we see price at a level, what we want to do is to validate a support or resistance level, we want to see 2 or 3, preferably at least 3 bounces off of a support or resistance level. The more times it bounces off that level without being able to break through it or stays above it, the more strength it signals. 3, asset prices tend to test support and resistance without breaking them. You'll likely become nervous when this happens. It's normal. Calm your nerves and learn to trust your charts. When a breakout occurs, it usually does so in the context of forming a new price trend. Your chart should give you a heads up to that in advance. 4, don't be lazy with your charts. The more you trade a particular asset, the more you'll feel as if you know how it moves in the area, as it moves. Be wary, okay, especially in binary options. Because in binary options, these surprising breakouts have time elements, and you should be very careful about those. But when you're trading Forex and CFD, you can trade these as reliable signals. Now, support and resistance aren't just random, because all the traders around the world are looking at these things. So we can expect price to have action. These, the more valid they are, the more times that they've been hit or touched, the more important they are. And there's buyers or sellers sitting in the market looking to get in the markets, to buy or sell. Or there's those in the markets that are looking to get out of the markets. They're all looking for information. Okay. Now, you can determine how you're going to use these in your trading, how valid you're going to use, what trading strategy you're using. But you shouldn't be ignoring these. They will help you understand. So if you combine support and resistance trend lines, because a trend line, once you draw it on properly, price stays above that trend line, it's working as your support level. If it falls below it, it's working as your resistance level. Combine that with eyeballing support and resistance, and then pivot point support and resistance. And pivot point support and resistance are just mathematical calculations that give you the next level of support and resistance around the current price. Okay, you can get them from all kinds of technical analysis places, and a lot of charting services will drop them on your charts automatically. And then there's services like AutoChartist that provide them and a whole trading system built around trends and support and resistance. So another group that make up resistance are the ones that bought at or near resistance and are trapped when price fell below resistance. These traders are begging for price to come up one more time so they can get out at break even. All of these groups work together to send price lower and make the supply in the supply and demand equation. More supply than demand, price falls. More demand than supply, price rises. So we can look at these on our charts because you can have short-term support and resistance level, longer-term support and resistance level. And like I said, you can just draw tops and bottoms and use these in the most recent price moves to get support and resistance. But if you look at this part on the pound, we can see how nicely when it entered this range, moved up to resistance, came back down to support, moved up to resistance, came back down to support, moved up to resistance, came back down to support. Same thing here, resistance, support, resistance, support. We could have been trading short-term trades, entering the market at support level when it bounced off it, exiting at the resistance level, entering the market again at support level, exiting at the resistance level, and buying again. And there's ways that you can place trades ahead of time. You know, you can place an order entry through order entry system to actually open and close trades at support and resistance levels. So for instance, if you're not sure the markets go up and you think maybe or come down, if you see a significant support level or resistance level, you can tell the system to open a trade only if it breaks above that level. And if it doesn't and it bounces off it, you can tell it to go short that trade. And then the system will just enter the trades that you set up at the appropriate times. So there's many ways you can use this to enter the market. Stop, think. Wouldn't this be a great way to set your stop losses or to calculate where your next level would be? And so if the market's falling, you'd want to know, okay, if it doesn't get support at that level and doesn't bounce off of it and breaks through, I want to close my trade. So you've told your system to close your trade just to drop below that support level. So again, there's many easy ways you can incorporate this in a trading strategy. But again, eyeballing, I love this picture, is one of my favorite ways. Because technical analysis is not an exact science, it is useful to create support and resistance zones. Each security has its own characteristic, and this is one of the reasons I strongly believe in eyeballing. Because when you're forced to deal with a chart and look at price movement on a chart and see what is done historically, you'll get to know the personality of that asset and the intricacies of that security. Sometimes exact support and resistance levels are best, and other times zones can work better. Generally, the tighter a range, the more exact the level. If the trading range spans less than 2 months and the price range is relatively tight, then more exact support and resistance levels are best suited. If a trading range spans many months and the price range is relatively large, then it's best to use support and resistance zones. Identification of key support and resistance levels is an essential ingredient to successful technical analysis. Even though it is sometimes difficult to establish exact support and resistance levels, being aware of their existence and location can greatly enhance analysis and forecasting. If a security is approaching an important support level, it can serve as an extra alert to be extra vigilant in looking for signs of increased buying pressure and a potential reversal. If security is approaching a resistance level, it can act as an alert to look for increased selling. So if you use it for anything, it can hit you on the head and just say, hey, open your eyes, pay more attention. Now, another great way to find support and resistance levels is to mark levels in the past where prices had a difficult time breaking through. As price moves up and down, each level that prices bounced off of could be a level in the future that price bounces off of again. Now, as I showed you, this is a manually intensive method and takes time to draw on all currency pairs that we trade, but it can pay off in the long run. You can also simply locate swing highs and swing lows. And by doing this and drawing lines that connect them together and finding multiple points where the swing high was the same and drawing them across on a chart can help you also look at these. So there are many different ways to draw these lines on your chart. Now, pivot points is the other one that I'm telling you about. Now, this is an example of a pivot point chart off of investing.com. So for this asset, which is the pound, we would then go, now pivot point charts are continually updated. Okay. And we would go to the pound on technical analysis on the pivot points on any Forex site, any news analysis, technical analysis site will have them readily available. Forex Factory, Investing.com, Forex Street, anywhere you find your economic calendars. Now, again, just a calculation, you can also use a pivot point calculator and constantly drop in the numbers that are required, and it'll continually generate them for you. Now, we don't want to pay attention to Fibonacci, Camarillas, Woodies, or DeMarcs. We only want to look at classic. We also would set our pivot point chart to fit the same time zone or time frame that our chart is in. Okay. Then we would simply go here and then extend lines at these prices. So we have resistance 1, resistance 2, and resistance 3. Now these are the 3 prices below the current asset price. Then we have support 1, support 2, and support 3. These are the 3 highest prices, or the price zones, or the price levels of that asset should touch moving forward. Now again, like I said, they're constantly recalculated. But if you look on this chart, let me just get my markings off of here. These are the levels that came off of the pivot point chart as opposed to eyeballing. And these are the levels above and below that asset. Now we can combine these together with eyeballing. And a lot of times you'll find your eyeballing probably gave you a better final number than the pivot point charts. Okay. And we can combine them with other tools to make these decisions. Here's one for gold. Okay, and we simply would draw it on our gold chart. And again, here's the euro US dollar. Now, if you notice, it's very colorful, it almost looks like a map. Then this is one of my charts, and each one of these colors means something to me. And when you find that you draw these lines of support and resistance on, you bring some forward, some are short-term, some are pivot, and you color code them yourself, you'll know exactly what they mean. And so I've built all of this on a chart, And it may look confusing to you, but I know exactly what these colors mean. I know what the dots mean. I know what the dashes mean. I know what the solid lines mean because it's my chart. And once you do this and start building your chart, you'll find it's not that complicated. Looking at somebody else's chart and interpreting what they're doing is different. Okay, but simply drawing these lines on. Now, I'm sorry, I flipped back here. Uh-oh. Okay, so when I had done this, this is back when the euro was trading at 114. Well, it's moved up much higher more recently. And so those lines down below, the purples, the orange, have no validity. They're not important to my trading now. But if the euro starts moving back down to that level, they all of a sudden become valid again. So now I've got my current price levels in the yellow up here around the current price. Now this is an older chart, so it's not Friday's price. But this is how you would do it. Okay. Now the more times the price bounces off of support and falls back to the resistance, the stronger these support and resistance levels are. It creates a self-fulfilling prophecy. The more often it happens, the more likely it is going to happen again. Now, the more those historical patterns repeat themselves, the more traders know and the more confident they become in forecasting future behavior. Some prices become so entrenched in the trading range that eventually it's hard to break through those levels. So understanding the concept of support and resistance, trading ranges, breakouts can be quite valuable to other traders. Support and resistance is one of the strongest and most dependable tools available to a trader. Remember that it is best to use any tool along with other indicators when deciphering whether or when to take an exit or entry point. So it's an important basic to understand. So hopefully tonight we gave you some general information. So when you follow along with us at ETX, first we have our class in charting basics. You need to understand charts, how to use your charts, how to use time frames, where to find your indicators. From there we go to teaching you how to put a trend line on your chart properly, and then we're going to go to, which we had today, support and resistance. From here we start going over to more the basic technical analysis and like our class on MACD and on individual analysis. And then we also take you over to our class on Fibonacci levels. And Fibonacci levels give you a different way of getting support and resistance levels. And these are all combined to help you build your own trading system and evaluate the markets on a more knowledgeable level. So thank you very much for joining us tonight. Thank you for being part of ETX. Enjoy the new time, or get used to the new time zone. Remember, our Sunday classes will be at this time from now on through the winter, and our Wednesday classes, I think, are also an hour early. And we'll talk to you on Wednesday. We have a whole bunch of new classes on the schedule. If you didn't come to our Bitcoin class, you can now trade Bitcoin US dollar on Bitcoin US dollar, pound, euro on ETX, and we have a class on it once a month. We just had it the other night. So thank you very much for joining us, and we'll talk to you again real soon. Bye now. The class has been recorded. If you want to see a recorded version, just use the same link you used for tonight's class, but give us a couple days, till tomorrow at least to get it up there. Thanks. Bye now.